Robinhood promised to democratize finance, giving everyday people commission-free trading and the ability to invest right from their phones. It was sleek, simple, and disruptive, but after explosive growth, Robinhood found itself at the center of controversy, lawsuits, and the GameStop short squeeze scandal. This is the story of how Robinhood revolutionized investing and how it nearly lost the public's trust. Founded in 2013 by Stanford grads Vlad Tenev and Baiju Bhatt, Robinhood wasn't built for Wall Street. It was built for everyone else. While traditional brokers charge $5 to $10 per trade, Robinhood introduced a radical idea: zero commission trading. It wasn't just free. It was mobile-first, modern, and addictive. Users could buy stocks, ETFs, and later crypto, all with a few taps. The sleek design made investing feel like a game. Millennials and Gen Z flocked to it. By 2018, Robinhood had over 6 million users and was valued at billions. But Robinhood didn't just make trading accessible, it made it fun. Critics argued that features like confetti, bright colors, and push alerts turned investing into a dopamine-fueled casino experience. Novice users were now day trading, often without understanding the risks. In 2020, a tragic moment occurred. A 20-year-old Robinhood user named Alex Kearns died by suicide after mistakenly believing he owed over $700,000. The incident sparked national outrage and a deeper look at Robinhood's design ethics. Reddit traders on r/Wall Street Bets launched a buying frenzy in heavily shorted stocks like GameStop, AMC, and BlackBerry, aiming to take on hedge funds. Robinhood was the weapon of choice. As prices soared, Robinhood suddenly restricted trading on several meme stocks, citing liquidity and clearinghouse requirements. Retail investors were furious. Accusations of siding with Wall Street spread like wildfire. Lawsuits followed. So did a brutal PR disaster. CEO Vlad Tenev was grilled in congressional hearings. Robinhood insisted it wasn't protecting hedge funds, but the damage was done. At the heart of the controversy was payment for order flow, PFOF, how Robinhood made money. Instead of charging users, Robinhood routed trades through market makers like Citadel Securities, who paid for that order flow. Critics claimed this created conflicts of interest and led to worse trade execution. Robinhood was fined $70 million by FINRA for misleading customers. Meanwhile, other brokerages like Schwab and Fidelity copied commission-free trading, removing Robinhood's unique advantage. Robinhood went public in July 2021 with a valuation of nearly $32 billion, but the post-IPO journey was rocky. User growth slowed. Regulatory pressure increased. The stock price plummeted over 80% within a year. Robinhood changed the face of investing forever. It pulled millions of new investors the market and forced the entire industry to adapt.